All right. Good afternoon, grade 12. Um, my name is Mr. Vermeulen, and I will be your new business study teacher, hopefully for the rest of the year. Um, I hope everything is fine on your side. And yes, we will do our best to prepare you for the year-end exams. Um, just be calm, and we will make sure you'll be ready. Right. Let's start. Um, Today we're going to do investment securities. Um, I will probably do this lesson on Monday again. I'm supposed to start on Monday, but I have learned late last night, that I must help out today. So we're gonna do the investment securities today, and on Monday we will revise on that with the other new lessons. All right, let's start. The importance of insurance for businesses. Boys and girls, the tricks, insurance for businesses is very important. You will see that in the slides and in the lesson right now. So let's start. Business enterprises need the following: insurance that enables business partners to buy a deceased partner's share in the business, cover for theft and fire if large amounts of stock are kept on the business premises, product liability insurance against losses due to damage or injury caused by failure of a business product or a product that the business sells, public liability insurance to protect the business against claims from people who were injured on a business's premises. Right, boys and girls, Matrix, you will see the first bullet, insurance that enable business partners to buy a deceased partner's share in business. That is insurance. The rest will be assurance. There's a difference between the two. The difference between the two is the following: insurance is insurance that covers your life if something happens to you, and assurance is assurance that cover your business, your products, your uh, like I said, your products and your business partners. All right, so let's go on. Individuals need insurance to enable them to retire comfortably, cover themselves against claims by people who sustain injuries in vehicle accidents. Let us stand still a little bit at that bullet, boys and girls. That we call the third party insurance that covers themselves against claims by people who sustain injuries in vehicles. That is, for instance, when somebody is in a car with you and you drive and you have an accident, and that person put in a claim against you, then your insurance will pay out a certain amount for that person. Okay. Cover their debts in the event of death. Right, boys and girls, that one, the most common one that we have on that bullet is when you buy a house for, say, 1.2 million bucks, then you need insurance. Okay, the bank will finance your house for 1.2 million rand, but what happens to that house if you die in, say, 2 or 3 months time? Then your children and your wife or whoever will be liable for that money to the bank, and you don't want that. So then you take out insurance for 1.2 million, and when something happens to you, that insurance company will pay that amount directly to the bank so that your house is covered. Right. Sorry for that. Provide income for their dependents in the event of death. That's the same, almost the same, boys and girls. You take insurance out on your life, let's say for 500,000 or 5 million thousand. So when you die, that amount will pay out to your dependents that you've chosen to be on that policy. Protect themselves against losses due to fire, theft, burglary, motor vehicle accidents, and storm damages. That is assurance, not insurance. Assurance, that's your short-term assurance that covers your car, your vehicle, natural damages, italics. All right. Protect themselves against losses due to unemployment and protect themselves against losses due to illness. Right, boys and girls, the last two bullets matrix is a policy that you can take out at Sanlam or Old Mutual that will cover you when you don't have work. Then that you can claim against that policy for a certain period of time, and that policy will pay out a certain amount salary for you for that period of time. Right, and the last bullet is losses due to illness. For instance, you take out a policy. You're a teacher, and you take out a policy, and that will cover your life. Say, for instance, you are getting blind. You cannot see. Obviously, you cannot do your work anymore. You cannot teach anymore because you cannot see. Then that policy will give you a monthly salary. Um, it depends on how long you want it, but normally the public take out that policy for lifetime. So if you are disabled to work, that policy will pay a salary to you for the rest of your life. Right. Let's go on. Right, boys and girls, the different types of investments. Investments are assets in terms of the following risk factors. Risk, ROIs, return on investment, influence of inflation, investment planning factors, terms of investment, and tax implications. Right, boys and girls? Investments is a very interesting, let me tell you, plain English, a very interesting game that you can play. You can invest your money into Alan Gray or wherever. You can have a moderate portfolio, or you can have a aggressive portfolio. Obviously, the moderate portfolio will give you a stable growth in your money with almost no losses. But if you have an aggressive portfolio, then you will make a lot of money in a very quick time, but you can also lose a lot of money in a very quick time. Okay, let's go on. Sorry, can we just go back to the last, to the previous one? I just want to stand a bit still on the last two bullets. The term of the investment, boys and girls, that is your own discretion how long you want to invest your money. I think the smallest period is 30 days to up until whichever year you want to invest to. All right, tax implications. Obviously, you are going to pay tax on your investments. All right. Right, boys and girls, business investments. When you have a business, there are a number of investment options available to businesses and individuals. Property investments, collective investment schemes, offshore investments, share investments, money market funds, and bank deposits. Right, boys and girls, I'm going to explain one or two of them. Property investments, I think that is the most, according to me, the most reliable probably. That is when you buy property. You invest all your money in property. If you have enough money, you buy a house and you rent it out. I think that is the best investment for me. Right. Let's go on to to the bank deposits. Boys and girls, you all know that. That's not very difficult. You Every time you receive money out of your business, you put it in your bank account, and it's earning rent there. All right. Share investments. You can buy shares at Sanlam or um, Investic or Mr. Price or wherever. That is a very, very risky portfolio because why do I say so? Because the one day you can have a lot of money in shares. The shares will be very good, and tomorrow morning when you wake up, all the shares have fallen down. So it's a very type of aggressive investment. Offshore investments, boys and girls, that's when you invest your money overseas. Any place overseas that you want to invest your money, obviously that will be in mostly in Europe. So you can have a choice where you want your money to be in offshore accounts. Right. Sorry for that. Right, boys and girls, Matrix, you all know the JSE, um, the Johannesburg Stock Security Exchange. Let's see what that body do for us. Right. The functions of the JSE includes the following: services as a link between investors and entrepreneurs. Service as an indicator of economic indications. Encourages small investors to obtain a share of the commerce of a country by buying shares. Enables financial institutions to invest their surplus funds in shares. Shares of companies are valued and assessed by experts. Provides a regulated vehicle for trading shares. And the last one, news about the JSE is distributed through its news service, Stock Exchange News Service, the SENS. Right, boys and girls, every night on the news, Afrikaans, Xhosa, Zulu, English, wherever you are looking at the news, at the end of the news, you will see the JSE Stock Exchange. Like I've explained previously, it's a very risky business, very aggressive portfolio because you can earn a lot of money today, and tomorrow the whole stock exchange can break down, and your shares will be worth nothing. So yes, it's a lot of information, but we need to prepare you for exams. So if I can give you a tip on the JSE, make sure you watch once in a week or twice in a week the news in whatever language you want to watch it, and watch the Johannesburg Stock Exchange. Right. Right, boys and girls, let's go on to the different types of shares that we have or that we can invest in. Right. Let's go to the first one. Preference shares. That is participating preference shares, cumulative preference shares, non-cumulative preference shares, redeemable preference shares, and convertible preference shares. Right, boys and girls, let me explain one or two of them. The convertible preference shares is shares that you can convert anytime to other shares like you want to. All right. Ordinary shares, that are also called equity shares. Okay. Founder shares, bonus shares, and other are the blue chip shares, growth shares, value shares, income shares, cyclical, cyclical shares, and the OTC stocks, over the counter shares. Right, boys and girls, let me explain you the bonus shares. Um, Example of that, I want to take Sanlam as an example again, or Old Mutual as an example again. Um, at the end of every year, they when they are supposed to pay out bonuses to the employees, they give the employees a option. They if they want their bonus money, or they are also eligible to get um, bonus shares instead of money. The company are giving them shares in the company. Um, that's obviously a very good uh, um, way to pay bonuses also. All right. Right, boys and girls. The unit trust, that's collective investment schemes. Advantages of the collective investment schemes or unit trust includes the following: easy and affordable to invest in units, safe investments, unit trust, all that things. Right. Let me see what they say on the slideshow. The four bullets: low risk investment because portfolio is managed by experts. Right, boys and girls. Remember previously I've said we get a moderate and aggressive portfolio. This one is a moderate portfolio because there's low risks and expert people are managing and investing your money. Right. Easy and affordable to invest in unit trust. Right, boys and girls. Unit trust is very, very cheap. The local guy, like us, can buy unit trusts. Not always the big guns who can buy uh, sorry for that. Like I said, we can also buy unit trust. All right, safe investment because capital is invested in different markets. Right, at the moderate portfolio, your money will be spread almost equally into different markets, so that you have an equal spread and a good chance of growth and a very low risk uh, um, of losing your money. Right. The aggressive portfolio does that is more aggressive because they only invest in one or two markets. So if that market falls, all your money will lose all your units will lose their value. Right. Unit trust can easily be sold on a stock market. Right, that's very easy. You can sell your unit trust at the JSE very easily over the internet or your computer or whatever. Not you are not this sorry, not supposed to be there at in person to sell your unit. You can do that over the internet. Right. Let's go on. Right, boys and girls. Let us see what is government retail bonds. That's the following: the RSA fixed rate retail savings bond and the RSA inflation linked retail savings bond. Right. Let us see what is the fixed rate retail savings bond. It consists of bonds with 2 year, 3 year, or 5 year terms. Remember, I've said previously, you have a choice about the time frame about when you want to invest your money. Right, earns a market-related fixed interest rate. Right, boys and girls, your interest rate is according to the market, and it's fixed. You cannot lose money. Right. Interest is payable on the designated interest payment dates. Alternatively, a bond holder can choose to reinvest interest. In other words, you have a choice to take the money, the interest for yourself, or you can reinvest the interest. Right? Investors who are 60 years and older might choose to receive their interest in a monthly basis. Why? The reason for that is when you are 60 years old, you are probably retired from your long life job, and you enjoying the life now without stress, um, and you have a choice for a monthly salary that you can receive um, from that interest. Very, very good way to get the extra money on your retirement salary also. Right. Sorry. What is the inflation linked retail savings bond? That's the following. Consists of bonds with 3-year, 5-year, and 10-year terms. The amount invested is inflation adjusted semi-annually. In other words, if the inflation is going up, your investment will go up. If the inflation is going down, your investment will go down. It's not a fixed interest rate. The amount right, the interest is paid every 6 months until the bond reaches maturity. Okay, so you will receive money every 6 months. A floating interest is applicable. It is derived from the government inflation linked bond yield curve. In other words, your investment um, will work with the government interest, the sorry, um, the inflation. If the inflation adjusted, your um, investment will adjust. But if it goes down, you will lose money again. Right, Matrix. I hope you are with me. Like I said, we're going to do that on Monday again. Um, just to recap on everything again, let's go on. Returns of investments. Right. Return on investment is the remuneration an investor receives from investing money. In other words, that's basically commission. All right. So let's say, for instance, you have a 10 million rand that you need to invest, and you give it to me. I'm the broker, and I will invest your money in a safe place. Then I will get commission on that investment that I've done for you. Right. Investors usually receive returns on investments in the form of dividends, interest, and capital appreciation. Right, what is dividends? Shareholders receive dividends as a return on their share investments. Right, boys and girls, dividends is almost for um, uh, only for guys who have businesses. So if you have a partnership, you have, let's say, a 2 or 3 or 5 guys in a business, then you will receive, each guy will receive the dividends on their investment. Interest, we discussed the interest. There I gave you an example. Don't worry about that sums that I've put there. I'll explain it to you on Monday again. I just want you to have a look at it. You have a simple interest and you have a compound interest. That's the only two things that you need to remember for the exams. They're only going to ask you which types of interest you get. Then you just tell them simple interest and compound interest. No need to make any sums, right? Or calculations, right? Capital appreciation, annual increase in property value that you receive only on your property, right, boys and girls? Like I've said previously, if you buy property, then your property will increase annually, right? For instance, if you bought the house for 500,000, at the end of the year, that house will be more profitable, or the price will be more than 500,000. All right. It's a mouthful on a Friday, but I hope you are with me. Like I said, we're going to do it on Monday again. Assessing an investor's choice of investments. Or, sorry. Right, boys and girls. Again, the different kind of investments: shares, unit trust, retirement annuities, endowments, offshore investments, fixed deposits, stock sales, business ventures, short-term investments. For example, notice deposit. Right, boys and girls, again, quickly, I'm going to explain one or two of them. Shares, you all know shares. We've just discussed that. We've discussed unit trust. I want to explain quickly to you what is in the retirement annuities and endowments, because you are now in matric. Next year, this time, probably one or two or three of you will have an annuity or an endowment. Right. A retirement and annuity, boys and girls, is the following. It's a policy that you can take out at a insurance company like Sanlam or Old Mutual, and you have a choice. You pay every month a certain amount, sorry, a certain amount, and that amount will grow with 10 or 15% every year, and it will pay out at the age that you have chosen, like on 55, 60, 65, and if I'm not wrong, it will pay out also at the age 70. Right, boys and girls, that is your retirement salary. All right, that you will receive the day that you retired from your work. Okay, it is very important for an entrepreneur, for example, a business owner, to have a retirement annuity, so that when you retire at age 60 or 65, then you will receive a monthly salary from that retirement annuity from age 65 up until the day that you are no longer with us. Right. Endowments, boys and girls. Endowment is very, very easy. You can take out also an endowment at the Old Mutual or Sanlam or wherever you want to. It's in short a savings plan. 10, 15 or 20 years savings plan. You pay a certain amount every month. The growing rates percentage for an endowment is also 10% every year. So you can have a choice with the savings plan, the endowments. If you want to have 15 years from now, you want to receive, let's say, 500,000 bucks, then the broker will work that out. What will your monthly premium be on that amount? All right, on savings plans, the endowments, you don't pay tax when you receive the money, but on the retirement annuity, you will pay tax every month, or sorry, for every year, up until the retirement annuity is paying out, and after the retirement annuity is paying out, you will keep on paying tax. I think the tax rate is now 15%. Right. Let's go on. All right, boys and girls, we are at the end of our presentation. Like I've said, it's Friday. I've kept it short because I've received only last night late the request to do it today. I hope you're happy. If there's any questions, you can pop a question. Like I've said, we're going to do it on Monday again, just to revise and recap everything. So yes, I hope you have a good or a nice weekend, and stay safe from the corona. Thank you.